Okay. What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis on one of my favorite stocks right now, and that is Oracle. Because I am up 40% on Oracle right now, up about $1,500. I'm very happy with this. I've only owned this for about 3 months now, and they are performing very well. So I'm going back and forth right now between do I sell some shares or do I hold on to everything because I'm trying to hold this into next year, but at the same time, this has run up really fast in a short period of time, and the valuation is not cheap. But I potentially can see it going higher. So I don't know. I might sell half. I might not. I'm not sure yet. But so Oracle, it's up to a $713 billion company. Okay. And they are benefiting massively off of this AI boom right now. So the RPO, remaining performance obligation, pretty much contracts of revenue that's supposed to come in the future, stand at over $550 billion, which is up over 300%. We could see this chart right here for cloud backlog has gone up to 550 billion, huge increase to where it was a couple years ago. And this backlog is anchored by massive multi-year sovereign and corporate AI infrastructure contracts. The infrastructure is growing at 84% year over year, changing the market share dynamics among hyperscalers. The Oracle databases natively inside Microsoft, Google, AWS has created a 500% surge in multi-cloud database revenue. These services carry ultra-high margins of around 70%, which boosts net income as they scale, outpacing lower margin pure GPU leasing. Oracle quietly cut between 20,000 and 30,000 employees while shifting product development to automated AI code generation. Analysts estimate this pivot will free up 8 to 10 billion dollars in cash flow. Very nice. They carry a staggering 120 billion dollars in net debt. As you can see here, it's not great. 130 billion in debt now, and only 40 billion in cash. Okay, keep in mind though, they're doing 16. I mean, yeah, free cash flow is negative because they're reinvesting into all this AI stuff. But net income is $16 billion. So hopefully in the next couple of years they'll be able to pay off that debt, but again that is weighing on them. Capital intensity building data centers to support massive backlog requires capex of over $50 billion alone for this year, and they will have negative cash flow until 2028 most likely. Here are some projections. I like to look at GAAP numbers, just because it factors in costs that the adjusted numbers sometimes don't, just because it's a one-time cost or something. I still want to see what that is. Mostly just the more conservative number is what I feel safer doing. I want to see the number that is lower because that means they're factoring in more costs. Driven by automated AI software development, high margin cloud expansion, blah blah blah. The GAAP net income is supposed to compound at about 22% per year, which is very nice. We could take a look at Yahoo's number: 17% revenue growth this year, 31% the following year, which is good. Nothing insane, but it's good. Especially, I mean, if they have a $500 billion in backlog, I mean, these numbers could be bigger, but it's still good. Then we look at GAAP numbers for EPS. We're looking at 4, 5, over $6 EPS next year. And then maybe in 2028, we see them pass $7 EPS. But on a GAAP basis, on a non-GAAP basis, those numbers are much higher, going over $8 for 2027. So, but again, I like to pay attention to GAAP just because it's more conservative. Either way, the stock is getting pretty close to a fair valuation. I mean, nowadays, valuations can push up into insane things, trading at 300 times earnings and stuff. So, this stock I could very well see this going back up to $300 and higher, even higher than that. That's why I want to hold on to some shares, but I might also take some profits because, as you're going to see here with the PE and stuff, it's just expensive. Fiscal year 2026 ending, okay, so 16 billion, 2027, we're looking at, 20, 24, 30, 35. Okay, and those are pretty solid growth numbers. Let's see, the 2029 marks the inflection point where capital capex begins to moderate. That's good. That's an important sign. So fiscal year 2030. One way to look at it is like, okay, so let's say 4 years from now they do 35 billion in GAAP net income, and we want to multiply that times their typical PE ratio, which, as you can see here, it is, on the low end, it's like a 20. On the high end, it'll get up to like 60. But in general, the average is probably somewhere around 30, 35, right? So maybe like I would say once you get to 40, that's a little bit richer. So like somewhere around 35, right? 35 would be reasonable. So 35 times 35 means it would be a $1.2 trillion stock. Okay, that's almost double where it is today. That's 4 years from now, though. But that's kind of why I want to hold on to it. And if growth slows, I could potentially see the PE only being like a 30. So in that case, 30 times 35 is about $1 trillion. Still, I mean, you could that is a 33% return over the next 4 years. Not great, but still, I don't know. It might be worth to hold on until at least next year just to see what happens. Same thing, Gap EPS and then PE. Yeah, they're bringing it down all the way to 20. Wow. So if that's the case, if they're only trading at 20 times earnings, they do 35 billion in sales, then it's trading at today's market cap, 700 billion. You see, and I feel like 17 times earnings is kind of cheap. I think it's going to be more around the 25 range. And so in that case, you're looking at an eight, $900 billion company. So again, it might have another 20% upward move or so and hit 300 bucks. But that's then after that, it's overvalued. That's the way I see it. So they are no longer acting as a slow-moving database. It is acting as a premier physical power grid for the AI ecosystem. Now, and they do have that debt. They do have negative free cash flow because they're reinvesting, and it's like, how long is that going to take for that to pay off? So I don't know. Oh, now what just happened? Just dropped. So I don't know. Part of me wants to maybe I should start taking profits. I'm not sure. We'll see what happens. But that's my analysis for Oracle. Let's see what has their profit margins been as well. I do want to see that. So they're down to 21%, which is not bad. That's kind of where they've been. So that's my analysis for Oracle, though. Let me know what you guys think down below, and I will see you in the next video.